This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The second part of the chapter, following on from your agriculture, is now looking at inventory. And inventory is a massive bit of revision, isn't it, from the days of F3 and F7. So I say there isn't anything too new, but we are just going to throw one slight little curveball in there as we go along. So I think you're very happy, or at least you should be, with how you value inventory at the lower of your cost and net realizable value. So remember, your cost is your purchase price plus your directly attributable costs of getting the asset into its condition and location ready for sale. So that's going to go through there and include your materials, your labor, and your manufacturing overheads. But remember, from the days of F7, that's based upon your normal output. Any variances will be subsequently dealt with. Yeah, we value it based upon cost, based upon your standard costing and your normal output. So what you expected to produce. If you had higher or lower production levels, then we don't make any adjustment to the manufacturing overhead cost per unit. The other situation then is looking at your NRV. Remember, we know that our NRV is our selling price, less cost to sell, less our cost to complete. Just be careful here, however, now is that when we're looking at our selling price, remember the selling price is the selling price that we have of the finished goods. So if you're trying to go through there and value your inventory and it's consisting of maybe raw materials or some work in progress, when you're looking at the NRV, you have to take the selling price of the finished goods and deduct selling costs and deduct cost to complete. Okay, you don't look at the selling price of the raw materials or the selling price of the work in progress to which it could currently be sold for. And I think that may be ever so slightly new. You may be being aware of it, but let's just bring it to the forefront of our attention. So when you're looking at the NRV and you're valuing the inventory at the lower of cost and NRV on a line by line basis, remember, you look at the NRV based upon the selling price of the finished goods. Okay. And I emphasize that because if we go through there and have a look at the other example that we have there within the chapter, that is emphasizing the point that we have there in hand, because it wants us to go through and work out the value of your closing inventory to be included in Bravo's financial statements. And what you've got there is Bravo is a manufacturer. It manufactures components for the retail industry. So if it's manufacturing, it's likely to have raw materials, work in progress, and finished goods. So it goes through a process. It has stages of production. It says the inventory is currently valued at cost. If we work out that the NRV is lower, then we would need to have an inventory write down. We're then told the cost structure of the equipment as follows, and you can see there that this inventory is subject to a process. You've got the production process, then you convert what is produced into then a finished good. And you can see there that you have the cost per unit for the production process, the conversion costs on top, which then add to give you the cost of, if you like, that finished good. Just note you're given the selling price per unit. So when you're comparing the cost to the NRV, you're going through there and looking at the selling price of the finished product, the $1,700 per unit. You ignore the selling price per unit of that first production stage. Okay. And I think they valued the inventory correctly at cost, because the selling price is 1,700, which is higher, isn't it, than the cost of the finished product. So they valued it at the lower of cost and NRV for the finished product. For the production process, you've got a cost of 1,000, and if you deduct the conversion costs of 500 from the 1,700, you get 1,200. So again, they've correctly valued it at the lower of cost and NRV, haven't we? However, what we then have to go through and consider now is the additional information, isn't it? And we're told that there are selling costs of £10 per unit. So we need to apply that selling cost of £10 per unit to the selling price, which may now have gone through and changed. We're told there's 100,000 in the first stage, 200,000 of finished product. So once we've got a value per unit, we can apply it therein. And it says there, shortly after the year end, so an adjusting event, a competitor released a new model, and this has resulted in Bravo having to reduce its selling price to 1,450 for the finished product. So that's what we would help use to work out our NRV. Yes, it says 950 for the first stage of the production, but that is not relevant. When we look at our NRV, we go through there and work out the NRV based upon the NRV of the finished product. So what we can go through and do there is we need to work out the NRV. So your selling price, so our expected selling price is that now 1,450, isn't it? Our expected selling costs, I think, were there as 10, weren't they? Which gives me 1,440 as our NRV for the finished goods, isn't it? Okay. Versus, is it the 1,500? Okay. So if that's the case, what we need to go through and do there is we need to value the inventory at the lower. The lower is there at the 1,440, isn't it? So you have to reduce the inventory by, is it $60 per unit? $60 per unit based upon, is it there, the number of goods that we have as finished goods, and it says there, is it 200,000 units of finished goods. Okay, so what we've got there is $60 per unit multiplied by, is it the 200,000 units? Does that go through there and give me a reduction of $12 million? Okay, which is your adjusting figure. You need to reduce the inventory by the $12 million because it is already included, isn't it, at cost. Okay. We then need to go through and work out the NRV, don't we, for the first stage of production. So just be careful there. We've got the same calculations. We've got the selling price, is it at 1,440? We have the selling costs of 10. We have the conversion costs, so the costs to complete, which I think were there as 500. So does that go through there and give me, is it 930? Careful, thought that looked wrong. That should be 1,450, shouldn't it? Okay, I have the memory stored, or the answer stored in my memory, and when I got 930 on my calculator there, I anticipated I'd done something wrong. You probably already spotted that, so if you had, very well done indeed. So what you have there now is that is the NRV, isn't it, of the first stage of the production process versus a cost which was there of 1,000. So they've got it recorded at 1,000. The lower of the two is the 940. So again, that is a reduction by, is it $60 per unit? I think we have, is it 100,000 units in the first stage, isn't it? So I think that is a reduction, is it, of $6 million. That's the adjustment that I would need to process to get the goods from their cost of 1,000 for the 100,000 units down to 100,000 units at 940. There we have it. That's inventory, valuing it at the lower of cost and NRV. And I think the key bit that you need to take going forward here is that what you've got there is when you're working out the NRV, you need to look at the NRV based upon the selling price of the finished goods. And that's particularly important when we're looking at a production process that goes through stages: raw materials, work in progress, finished goods. Other than that, I really don't think it will get any more complicated than that if it was to appear within the exam. If it was to appear within the exam, where would it appear? I'd have thought that given that is a numerical style question, that's more likely to appear in question 1 as part of your group accounts question, and that adjustment there will be required in the parents' books. So when you're making the adjustments there, is it for the 12 million and is it there for the 6 million? You need to reduce the inventory within the group accounts on a line by line basis. So in the inventory line, you would deduct 12 and 6. And then you need to process the other side of the entry, which would be a reduction in the parents' retained earnings, which would be there, wouldn't it, in working 5. There you go. Inventory, revised and complete. I'll see you all in the next chapter.